Hey everyone, welcome back to Corporate Decoder. Today, California BanCorp or B.C.A.L just filed its quarterly report, and I'm seeing some interesting trends in their loan book that investors need to understand. Quick note, this is not financial advice, just my take on public filings for educational purposes. The bank's loan portfolio shows a significant shift, especially in how they are managing risk and dealing with interest rate changes. Alright, let's dive into the numbers from this report. California BanCorp, or BCAL as you might know it, has put out its quarterly update for the period ending the 30th of June 2026. Looking at their balance sheet, total assets are sitting right around $4.03 billion. That is a slight dip from the end of last year, mainly because they have less cash sitting around. But their loans have actually grown a bit, and they've also increased their investments in debt securities, which suggests they're putting money to work. Now, for the profit picture, for the second quarter of 2026, they brought in $14.3 million in net income. That is a small increase from the first quarter and pretty much in line with what they made in the same quarter last year. Diluted earnings per share are sitting at 44 cents for the quarter. The engine driving their profit is net interest income. For this quarter, it was $43.4 million, up slightly from the previous quarter and also up from last year. This tells us they're making more on the difference between what they earn from loans and investments and what they pay out on deposits. However, they did have to set aside more money for potential loan losses. This quarter, about $714,000. This is up from a slight release of those funds last quarter, but still lower than the amount they released last year. It seems they're being a bit more cautious about future loan defaults. Non-interest income, which includes things like fees and service charges, was $1.55 million. That is a bit lower than last quarter and a noticeable drop from the same quarter last year. A big reason for this drop is lower income from their equity investments and also less income from selling loans. On the expense side, non-interest expense was $24.3 million, which is actually down from both the previous quarter and last year. They've managed to trim some costs here, particularly in salaries and employee benefits, likely due to managing staffing levels and also benefiting from deferring some loan origination costs. This expense control shows up in their efficiency ratio, which is a measure of how much it costs them to generate revenue. It came in at 54.2% this quarter, down from nearly 58% last quarter. That is a good sign, meaning they're becoming more efficient. When we compare this quarter to the same quarter last year, net income is up just slightly by about $200,000. But the story here is that net interest income grew significantly, up nearly $2 million. They also managed to cut down on non-interest expenses. However, they had to increase their provision for credit losses, meaning they're anticipating some potential trouble ahead. Looking at the first half of the year, net income is down about $2.9 million compared to last year. This is mainly because they had to set aside a lot more for potential loan losses, nearly $4.7 million more than last year. While net interest income did grow, it wasn't enough to offset that higher provision for credit losses and a drop in income from selling loans. Now, let's talk about the core of any bank, the loans. Total loans held for investment are about $3.09 billion. That is up from the end of last year, but the composition is interesting. Commercial real estate loans are still the biggest chunk, representing over 61% of their total loan portfolio. This is a common strategy for regional banks, but it also means they're exposed to risks in the commercial real estate market, which has been facing challenges with rising interest rates and changing work habits. Construction and land development loans are also a significant part of their business. These are often riskier because they depend on the successful completion and sale of projects. They've seen a slight decrease in this category recently. Digging into loan quality, they are showing a rise in substandard loans, particularly in commercial real estate and commercial and industrial categories. Substandard means the loans have weaknesses that could lead to problems down the road. This is a key area to watch. And speaking of problems, non-performing loans have decreased significantly to $8.9 million from over $16 million at the end of last year. That is a positive sign, showing they've managed to resolve some problem loans. However, they also had to add more to their allowance for credit losses to cover future potential losses. Interestingly, their allowance for loan losses as a percentage of non-performing loans has jumped up dramatically. This suggests they are much more conservative in covering potential losses on their bad loans compared to last year. Their investment portfolio, particularly the available for-sale debt securities, has grown significantly. This portfolio is valued at over $308 million. However, they've seen a rise in unrealized losses on these securities, meaning their market value has dropped below what they paid for them. This is largely due to rising interest rates impacting bond prices. Shareholders' equity is up to about $586 million. That is a good sign, showing the company is growing its equity base through retained earnings despite buying back some of its own stock and paying dividends. They also approved a new equity incentive plan, which is fairly standard for companies looking to reward employees and executives. Now, like many banks, California BanCorp is heavily exposed to interest rate risk. They're actively modeling how changes in interest rates could affect their net interest income and the overall value of the company. The report suggests that if rates were to fall significantly, they could see a hit to their net interest income, while rising rates would be more beneficial to their earnings, mainly because their loans reprice faster than their deposits. This is pretty typical for banks, but the magnitude of these projected changes is important. So what is the big picture here? California BanCorp is navigating a complex financial environment. They're showing strong net interest income growth and have improved their efficiency. However, the rise in substandard loans in key segments like commercial real estate is a concern. They're also carrying a substantial amount of debt securities that have seen unrealized losses due to higher interest rates. The way they're managing their loan book, particularly their exposure to commercial real estate, will be critical. The increase in their coverage for potential loan losses is a prudent move in the current climate. The risk I am watching is how these commercial real estate loans perform, especially those in the office and construction sectors, as interest rates remain elevated and economic uncertainty persists. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join the Discord.